My name is Shane Handy. I am the founder of The Rational Trader. This is a 5-part video series on trading the markets using visual order flow. Visual order flow is a way to graphically display the order flow data so that we spend less of our time picking apart the data and more time applying it to what the market is doing. Our agenda is the first video, part 1, is Introduction to Wave Volume. This is a technique we use to help us choose direction. Part 2 is an introduction to order flow. This is basic concepts and a way to graphically display it so that it is easier to see what is happening. Part 3, there's a lot of ways to enter the market. We're going to look at one in particular, which is understanding breakouts. So when the market moves to a level, looking at the order flow to help us make a decision on whether we think that breakout's going to succeed or not. Part 4 is an advanced order flow view, looking at the data in a little bit different way and then displaying it differently to help us understand where is the momentum in the market. And then part 5 is bringing it all together, how I read the market using visual order flow. Now, before we get started, we need to talk about risk. So trading is risky, and you can lose all of your money. And with futures, because of the leverage, you can actually lose more than your initial investment. There's some other elements listed on screen here that are important, and I'm going to come back to them in a moment. But first, I want to talk about the nature of risk or the source of that risk. And I think this is something that people misunderstand, and as a result are focusing in the wrong area as they work to manage their risk. The first component of risk, the first source of risk, is the market itself. I call this the technical risk. The market, we are trying to predict the future. That is inherently risky, and as a result, we need to deal with that. This is what most people think about when they talk about the risk in the market. Dealing with the unpredictability, the probabilistic nature of trading. The problem is this is not the only source of risk, and in fact, I don't even think it's the most important component. More important is the physiological risk, or the biological component of risk. And what I'm referring to here is that when you put money at risk, your body responds to that threat in the same way it responds to every other threat. It initiates a physiological response that causes fear, anxiety, doubt, and the flip side of these, excitement, greed, and euphoria when things are going your way. This physiological response impacts your ability to make sound decisions and has to be dealt with. All right. The Rational Trader was designed to recognize that this is the largest component of risk that you need to deal with, and creates a program that is intended to help you overcome it. That's what the Rational Trader does. Now, let's go back and look at suitability, performance, and hypothetical results. Suitability is talking about do not trade with money you can't afford to lose, because you are likely to lose it until you learn how to trade. Okay? You need to start small. The other component here is that you may discover that you don't have, because of that physiological response, your trading is not for you. And if that's the case, the sooner you know that, the better. The next is performance. Two people can use the same method, the same technical method, and have vastly different results. And the reason is their physiological responses and how they deal with them as they trade. This is why person A can be successful and person B will fail, even though they're using the same thing. Okay. Hypothetical results are simulations. These do not have any element of the physiological risk at all, and are therefore useless. Just ignore them. Okay. With this in mind now, let's get started. This is part 3 of our series on trading the markets using visual order flow. We're going to talk about breakouts, and specifically how we can use the wave volume and the order flow to help make a decision on whether or not we think that breakout's going to succeed, and then how to enter. We're going to talk about direction. In other words, what direction of breakout am I interested in? It's not just anything. and entry methods, specific entry methods that range from aggressive to conservative, as well as sort of what I like to do that is really governed by my personality, my trading personality. So it's really important actually as you trade to understand what kind of trader you are and make sure that you're setting up your trade setups to fit with how you like to trade. And then finally, we'll talk about buy pressure versus sell pressure at the breakout. And this is a very interesting discussion on sort of what happens when the market breaks out and how it can help you understand what to do. This is the chart that we've built up to this point. So this is part 3 of this video series. If you haven't watched part 1 and part 2, stop the video, go back and watch those parts. This will not make any sense at all to you if you haven't seen those. Now, this is the same day we've been working with. This is 8/8/2017, the NASDAQ. It is a 10-tick range bar chart. The market is opening here at 6:30 Pacific at the green line. 7 o'clock here is often news, or at least top of the hour, so there's some volatility there. I like to pay attention to that. And then the orange line, the opening price, and then this white line here is the overnight low, or the Globex low. All right, now the first thing that we notice is that our wave volume is pointing down. All right, so independent of anything that's happened overnight or what the larger picture is, without considering that at all, the wave volume says short. Okay, you've got a divergence signal here where you've set a new high on lower volume, so it's looking at the wave volume down here. Okay, and you're showing a no interest short. In other words, I see that same declining volume, but I see more down volume than the volume in the most recent up wave. Okay, so the level that's been set is right here. And because we are pointing short, we're interested in taking a look at breakouts that occur at this level. If the market breaks higher here, there's not a setup for me because I'm only going in the direction of the wave volume. The wave volume governs my direction. It's a very easy way to stay grounded and keep yourself on the right side of the market. It can remove all the anxiety and fear and doubt about which direction to go. All right, it is not always right by any stretch of the imagination, but it makes it easy for you to figure out what to do. All right, it removes the anxiety. So we break lower here, and we have big selling. By big selling, I mean a pink bar, and as we went over in part 2, what that means is that the aggressive selling that we see in that bar is at least 50% greater than the average of the aggressive selling over the last 10 bars, where we've defined aggressive selling as the amount of selling we see at the edge, at the bottom of the bar. So the amount of selling, the amount of, technically, the amount of trades going off, all right, at the bid in the bottom third of the bar. Okay, now it's pink, which tells me it's legitimate to short this. All right, and so now the question becomes, well, what, how should I enter? All right, so let's talk about how to do that. The different choices you have, and we're going to go from most aggressive to most conservative. All right, the most aggressive is as soon as this bar goes pink, while it's still drawing, enter at the market. Now, before I do that, I should talk about how I set risk and reward here. I'm not interested in scalping a few ticks out of the market. I'm trying to catch the major move of the session. All right, and typically speaking, I will trade with a stop that is equal to the height of the bars in the range bar chart. So that's a 10-tick stop. And I go for 4 times my risk. So if I don't think I can make 40 ticks, then I won't take the trade. All right. There are times when that comes into play because you may have a key level that you're going to run into long before you could reach your target. I have a very rigorous way that I manage stops, and I'll kind of explain what would have happened. The actual stop trailing discussion is out of scope for this video. All right, so I'm going to set my target to 40 ticks. I'm going to use a 10-tick stop and let it go. All right, but we got to get in. So how are we going to get in? All right, and again, there's a range from aggressive to conservative. So most aggressive at the market as soon as it goes pink. Okay, so here is our a text description going from most aggressive to most conservative. The most aggressive as soon as it goes pink, and you're breaking through here. So you would have had to have traded below this level. So 1950s would have had to have traded, and you've gone pink, you go in at the market. I don't do this. I prefer a little bit more confirmation. All right, so the second aggressive entry is to wait for the bar to close and then enter. All right, so the bar closes and then I place an order. And the order that I'll place is I'll go one tick back so that my 10 tick stop is one tick above the bar. All right, so that's here. The stop will be here. My entry, the order would be placed right there. You can see that in this case, I would miss it. All right, now, you can see it does pull back, so you would get filled on that pullback, but that's not how I trade. The way on a breakout, my expectation is that the market is going to go, all right, with one little exception we'll talk about in a moment. And so what I do is that when I place that order, if I get 2 bars in the direction of the trade and I haven't been filled, I will pull the order. Okay, so in this case, this bar here is going to close down, and this bar here is going to close down. I haven't gotten filled. Pull the order. I missed it. All right, or wait for a second entry to set up. All right. The next choice is to wait for the bar to close, but then offer back a little bit more conservatively than just one tick back, or at least offer back in a way that's a tad more intelligent. And the way that we do that is we look at the actual volume of trading occurring in the bar and use that to help us make a decision. So to do that, we have to go over to this volume at price chart, which is the chart that uses the numbers bar study. It's showing us where the amount of trading occurring at the bid and the ask, and specifically we're interested in where did the most trading occur, what price level. And typically the idea here is that there was a lot of interest at this level. The market will move back to a level where there's interest, and so get one tick in front of that level. In this particular case, that means right there. All right, one tick in front of 59.19. Typically speaking, this node is higher up, and you're actually placing a more conservative order, which is why it's considered more conservative than just one tick back. In this particular case, it's telling you, look, there was a lot of interest at 59.19, and if you want to get in front of that, you'd place your order at 18.75. Now, I would not do this. I would choose the more conservative of the choices, which are, one tick back at 19.25 with my 10 tick stop above the high of that bar, rather than at 18.75. All right, that's just the way that I would do it. It's supposed to be more conservative, which means I would expect that to be a more conservative entry. All right. The fourth choice is what's called a vacuum entry. It doesn't set up here, so I'm going to wait to describe that because it does set up for this long over here. It's my favorite, actually. So we'll discuss that in quite a bit of detail in a moment. The fifth, the most conservative, is the pullback. So waiting for once you've broken through it, very commonly the market will it'll pull back to. Oops, wrong button. After it breaks through, it'll pull back to the break level. You can see this a lot. All right, and so it's reasonable to just wait for that pullback to occur. There's 2 choices there. What I call the blind pullback is as soon as it breaks through, you're just placing an order at, one tick below the level. So that would be 1950. In this case, that would be just an absolutely gorgeous entry. You'd be loving that. All right. I consider that a bit more risky than the next choice, which is the touch and close. I'll explain that in just a moment. The reason is that you could easily be just, building up, quite a bit of momentum as you pop back higher, and it could easily just blow through your stop. All right. So I prefer to see it when I do this, to see the market touch this level, in this case, it's 1950, that level, and then I want a down bar. So touch the level and close down. Prove to me you're not going to just blow through it. And in which case, I would place the order one tick back off the down bar. So that down bar is right here. We touch, we close down. It has extra validity because there's big selling in that bar. So sellers stepped in hard after we pulled back. And I would place that order right there, one tick back with a stop, my 10 tick stop just above the highs here. In this particular case, sometimes I'm not going to get filled. Other times I'm going to get filled, but I'm going to end up scratching on this trade. All right, so the way that I manage the trade is my expectation is we're going to take out this low and just crack, and I'm going to get my 10-point target. So as soon as I get 5 points or 20 ticks, I'm going to move my stop to my entry and then just let it go. And in this case, it's going to come back and stop me out. All right. Let's look at the breakout over here and then walk through the different entry methods and see how they would have worked out. All right. It's really important that you figure out sort of where you are in this spectrum between aggressive and conservative. All right, because if you're a conservative trader, you don't want to be doing aggressive entries. It's going to generate lots and lots of angst and fear and anxiety that's going to impact your ability to actually do what you're supposed to do. Figure out where you are in this continuum, and then set up your rules and follow those entry rules. All right, it means that sometimes you'll miss it. It means that other times you'll save yourself a loss. But in all cases, you are developing the discipline that you need to be successful as a trader. Okay, know what to do. Do the right thing. That's how you overcome this physiological response that you have when you put money at risk. Right? This is a key principle of the rational trader. You have to drill in order to teach your body to respond differently. Right? This is the armed forces do the same thing. We do the same thing in the martial arts. Put yourself in a position to feel the fear, know what you're supposed to do, do that. Every time you do it correctly, you get a little bit better the next time. Eventually, the fear just disappears. All right. All right, I had to take a short break there. Let's continue. We've broken through the low here. All right, whoops, here. And, we pulled back. I might be short from here. It depends on whether I took that trade or not. And now, the market has set another level here. Now, this is kind of key now. When we break through this low, there's zero indication that that breakout is going to succeed. It doesn't mean it won't, but I don't have anything to work with that says, okay, I see aggressive selling. So I'm, shorting that break is off the table for me. You get another pullback, but in the meantime, you set divergence long. And so as we discussed in the part 1 video, you're setting a new low on lower volume. So this should not be happening, right? If you're going to break lows and break highs, there should be more volume, not less. But you bounce up, you pull back. So at this point here, if I'm still looking short, I'm now reevaluating. Once I see, it's actually when this bar draws, we get the divergence signal. It's now time to reevaluate my short if I still want to be short or not. We complete this wave, and then we come down again. Now, we'll talk about in part 5 the trade setup that's happening right here, okay? That's unrelated to the order flow strength study, all right? What does happen, though, is we get no interest long, all right? So now we've got this level up here to work with, and you can see very clearly that we break through here on aggressive buying, all right? And so this is the time to talk now about this fourth entry, my personal favorite on the breakouts, which is my entry is one tick below this next bar. All right, so let's talk about, let me make that a little bit brighter so we can see it here. We'll go pink. Yeah. All right, so what happens here is they're sitting above this level. I didn't mean to erase that. Sitting above this level here, there are two sets of stop orders. One set is the people who are short and are they need to get out if the market trades through that level. That's their assessment, is that if they trade through that level, the market's no longer going down and they need to get out, either to minimize their loss or to take their profit if they were short from earlier. Okay. The other sets of stop orders that are sitting up here are buy stops for people who want to get long on the break. All right, so they're blindly buying the break. Something that we're not doing, right? Something that I'm not doing, in that I want to see how the market behaves at the break before I make a decision on whether I think that break will succeed or not. So what happens is that when you break through, those sets of orders execute all at once. And so one way to think about it is like this. If you consider this a consolidation, okay, you can see the market's trading up and down. All right, I'm going to make this a little bit smaller just for drawing. I need the space to draw. the market is consolidating here. And a way to think about this is there is downward selling pressure, okay, all the way through here, and there's also upward selling pressure, upward buying pressure, okay, and it's basically equal, all right, and that's why the market is stuck in this range. And one of the things that happens here when you break out of that range is suddenly there's a dramatic, all these buy orders execute, and there's a dramatic decrease in the number of buy orders that are in the market. The buying pressure suddenly changes, and without these other buy orders sitting in the market to maintain that equilibrium, there's a lot of short orders now. And so what will happen is what you see here. You break through, and then there's this vacuum gets created here, and the market will fall right back down into it. And that's what this down bar represents to me. When I see this, this is how I interpret what's happening. And so what I do is I'm using this buying strength on the break as a way to assess that the market, this breakout is going to succeed. And now I'm looking for an entry, and I like to use this vacuum pop entry as a means to get in. And so as soon as this happens, as soon as this bar finishes drawing and I've got a clean break signal, this next bar starts drawing, and because it's a range bar, I know exactly how high that bar will be, and I just place an order one tick below where that bar would close if it closes down. All right, and I'll do that 2 times. So if this bar closes up and then I've missed it, right? The next bar starts drawing, then I'll move the order. And if I don't get filled, then I don't get filled, so be it. That's kind of what happened here on the short, right? It broke through, and then it just kept falling. It didn't give me any vacuum type entry there. All right. A little bit safer, a little bit more conservative on this vacuum entry is to let that bar close down and then wait for the next bar to close up and then get in here. One tick back off the high of that bar. All right, so that sometimes you'll break through like this and the market will just collapse back down. All right, it's a false breakout. And the study here is not working for us in that case. And so if you're nervous about doing this kind of entry, wait for the next bar to close up would be a more conservative way to handle that. Okay. My targets here are 4 times my risk. That's going to be, so that entry would be 1925. 29.25 is where I'm aiming for. This is kind of interesting because you can see here you actually get quite close to it on this initial thrust here, and it's an open question whether I would sort of drag the stop up and take 8 or 9 points, or follow my normal trail rules, which would have me moving the stop once that bar closes, and then I would move it to there, and then we'd hit my target on the next thrust. All right, now let's continue here to see what happens, and then we'll wrap up this video. We have a really strong move here. Okay, and so it's not unusual for that to be the top. We often see spike moves at tops and bottoms. And in fact, what happens is, this next thrust, we break the high on not very much volume. All right, and we see that once the market pulls back a bit. Here's that volume. This is divergence, so we're breaking highs on less volume. So at this point, if I'm still looking long, I'm stopping and reevaluating. Do I really think the market's going to continue higher? The wave volume says short. The easy thing to do is simply wait. I'm now looking short and then see if a setup occurs, or if the direction changes. In this case, we get a very clear no interest long signal. So some people really like this, where there's been a strong move and then you consolidate a bit and then you get a signal in that direction. I tend to be a little more contrarian, and so I tend to not trust this so much. It kind of depends on your personality. Sometimes you're going to be right, sometimes you're going to be wrong. When I'm not sure what to do, I just follow the wave volume. So in this case, I'd be looking long here. You can see, let me clear all this off. We've set a high here. We've set a level here. And so let's see how the market behaves when we get there. Here's a case where we're breaking through this, right? And there's no suggestion of aggressive buying as we break through. So just using this particular view of the order flow, I don't have anything to work with here in order to enter on this break. We will see in part 4, where we're using a more advanced order flow study, that there is an action you can take there. So let's continue though, because something interesting happens a little bit later on. We break through, and it's actually a pretty strong break. If you were using one of these vacuum entries, a vacuum pop entry, it would be right there. All right. Again, I can't do that because I don't see aggressive buying here, just using this particular study. But what's interesting is this bar. Okay. Now, I don't like an entry here at all because this is clearly chasing to me, and particularly for newer traders, and since I'm teaching a lot, chasing is just always bad. And so I won't do it. And in general, I don't think you should. But what's interesting about it is that you see the break, and then you see some selling occur. And we're going to talk more about this in part 5 when we talk about reading the market. And that selling, there isn't enough there to stop it, you'll notice. You just kind of, the next bar advances and you break through, and now you see aggressive buying. That's a reasonable entry if you're adding to your position, I think. I don't like it as a new entry. Some people will do it. They like these cases where there's been a strong move, a direct move, and then you get strength. There's been a direct move, and then you get strength. It's the kind of thing where you have to have a set of rules that act as guidelines for your behavior, and then follow them. Okay, and those rules need to be defined before you start trading. All right, not during the trading day, and certainly you're not changing what you're doing in the middle of the trading day. You're setting yourself up for being whipsawed by whatever the market happens to be doing at that moment. All right, so what I teach is that we have this method of looking at a breakout and identifying if we see strength, and assessing if we think that breakout is going to succeed, and then a range of entry methods that describe how to get in the market from a very aggressive to a very conservative approach. And what I teach is define what method you're going to use in advance, and then just do that. Just follow that rule. And do that for a week or 2 weeks or 3 weeks, and then look at your results. Look at how you were able to execute that entry, pulling the trigger, and evaluate whether or not you want to make that change or not. Now, you can be as simple or as complex as you want, as long as it's clear what to do. So, for example, what I've noticed is that when the market breaks lower, it often does not give me the pullback or even the vacuum entry. And so I will, it's not unusual for me to take a more aggressive approach on short breaks than on long breaks. Okay. So I could go into the day or into the week and say, for short breaks, I'm going to go aggressive. I'm going to go on bar close, one tick back. So number 2 here. But on longs, I'm going to look for my vacuum entry or a pullback entry. Okay. That would be a very reasonable thing to do. The other thing you can do is, prior to that trading day, look at how the market has been trading that week or in the overnight session, and then make a decision on, okay, these are the entry methods I'm going to use today. And write those down, and then you're only allowed to do what you said. You don't get a change in the middle of the trading day. It's too easy to let your emotions get in the way of your objectivity. Okay? So let's wrap this video up. And what we're doing here is we're using the zigzag to help define the levels that we're going to look at for breaks. We're using the wave volume to help us choose the direction of the break. And then the order flow, aggressive buying and selling study to inform our decision on whether that break is going to succeed. And then a range of entry methods. So what we see here, no interest short. There's a short break there. Very clear aggressive selling on the break. Nothing here. We break through. There's no suggestion. All of these breaks up here are off the table at the moment until you get that signal. All right, and then it's confirmed with no interest long. And so now this is a level to work with. We get an aggressive selling I'm sorry, aggressive buying on the break higher there. So this is an opportunity to execute our entry method. And then we get this really nice strong move. It starts to look short, changes, so at that point you could take a break here, all right, but we don't break through, right? Instead, we get no interest long, and so now this break is in play up here. All right, that is it for this part of the trading the markets using visual order flow. Next part, we're going to go into a more advanced view of order flow, which is what these bright red and green outlines are.